Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Microsoft.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So let's just get right into the thick of it today.
Yeah, we really have to, because I was looking at my portfolio this morning and just looking at the broader market, right? There is this massive elephant-sized question mark hanging over the tech sector.
There really is.
I mean, it is late February 2026, and we are so used to big tech being the safety trade.
Right, the place you just park your money and watch it grow.
Exactly.
Yeah.
But I'm looking at a chart from Microsoft today, and it's ugly.
It's very ugly.
The stock is down 18% year to date.
Yeah.
And that is not a wobble. That is a full-on correction.
It is a correction. And it's jarring for people, isn't it? Because usually companies of this magnitude, companies with this kind of market cap don't just move like that.
Right.
Unless something is fundamentally broken.
That's exactly what I thought. If I'm holding this stock and I see nearly a fifth of the value wiped out in 2 months,
You panic.
you panic. Because usually when a titan like Microsoft drops that much, there's a smoking gun.
Sure, disaster earnings report or CEO scandal or regulator stepping in.
Right. So naturally, I grabbed the Q2 fiscal year 2026 earnings report.
Looking for the disaster.
Exactly. I was ready to see missed revenue, lowered guidance, the works.
And what did you actually find in the wreckage?
I found gold. And that is the huge disconnect I want us to start with today.
Okay.
The numbers look incredible, but the stock price looks terrible. So help me bridge this gap here. Why is the market punishing a company that seems to be printing money?
Right. So this is the core conflict right now. You've identified what we call a price-performance divergence.
Okay.
And to really understand it, we have to look at expectations versus reality. Because the market sentiment, the vibes, if you will, has been incredibly fearful lately.
Because of the macro stuff.
Yeah, exactly. There was all this late afternoon selling pressure across the entire tech sector recently, driven by broader macro fears and a sector rotation.
So it just drags everyone down regardless of quality.
Partially, yeah. The baby gets thrown out with the bathwater. But there was also specific fear regarding Microsoft.
Which was?
Margins. Investors saw how much money Microsoft was spending on AI.
Oh, the spending, right.
Which we will definitely get to in a moment because the numbers are staggering. But investors saw that and assumed, oh no, their profits are going to shrink. They're just burning cash.
Okay, so that's the fear. That's the emotional reaction from the market. But what is the actual reality?
The reality is strictly in the hard numbers of that Q2 report you mentioned. Let's just look at the top line. Revenue hit $81.3 billion.
Let's just pause there. $81 billion in 3 months.
It's hard to wrap your head around.
It really is.
And that's up 17% year over year.
See, that is the part that blows my mind. Because we aren't talking about some small biotech startup going from 1 million to 2 million.
No.
We're talking about a company that was already gargantuan, finding a way to grow 17%.
Right. It defies the law of large numbers.
Exactly. That's like adding the equivalent of a Fortune 100 company to your revenue in a single year.
It is. Growth is supposed to slow down as you get bigger, but Microsoft is accelerating. And they didn't just grow, they beat the street.
What were the estimates?
The consensus estimates from Wall Street analysts were hovering around 80.2 or 80.3 billion, so Microsoft cleared that easily.
But what about the bottom line? Because, revenue is vanity and profit is sanity, right?
Right.
If they made 80 billion but spent 81 billion, we obviously have a huge problem.
Well, profit was actually even better. Earnings per share, the EPS, came in at $4.14.
Okay.
And the forecast was only $3.92 or 93 cents?
Wow.
Yeah, so they made significantly more profit per share than literally anyone expected.
Okay, so let me just recap this disaster that caused the stock to drop 18%.
Go for it.
They sold more software than expected. They made more profit than expected. And they grew at double digits.
That is the summary, yes.
I mean, it feels like the market is gaslighting us.
It does feel that way, but honestly, this creates what we call a dislocation.
Okay.
The fundamentals, the actual health of the business are going up, but the price is going down.
Yeah.
And for a savvy investor trying to build wealth, that gap is exactly where the opportunity lives.
A buy the dip scenario.
Textbook buy the dip. Because eventually, price has to follow performance.
Okay, so the engine is clearly running, but I really want to know what's fueling it.
The cloud.
Right? Because for years, Microsoft was the Windows and Office company. Then they were the cloud company. What is it today? It can't just be people buying laptops.
No, the hardware side is actually a much smaller piece of the pie now. The main driver is the intelligent cloud segment.
Okay.
That is the heart of the modern Microsoft. This segment alone surged about 28 to 29% year over year.
Wow.
We are talking about over $32 billion in revenue just from the cloud.
32 billion. And when we say intelligent cloud, we're mostly talking about Azure, right?
Azure is the crown jewel, yes. And this is where the growth story really shines. Azure and their other cloud services specifically grew 37 to 39% in constant currency.
Constant currency.
Yes.
So for you listening, that just means stripping out the weird fluctuations in the dollar versus the euro or the yen, right?
Exactly.
Just so we can see the real actual demand.
Correct. It gives you the true picture of the business velocity. And nearly 40% growth for a platform as big as Azure is just staggering.
It's massive.
Because you have to understand, Azure isn't just some hard drive in the sky where you save your family photos.
Right.
It is the computing backbone for the world's biggest companies. It's where they run their apps, their databases, and now their AI.
So if Azure's growing nearly 40%, that means the global demand for computing power is still exploding.
It is accelerating.
Yeah.
And the guidance, what Microsoft told us to expect for the next quarter, shows absolutely no signs of stopping.
What's the target?
They're expecting Azure to continue at roughly 31 to 32% growth.
So that's sustained high-velocity growth. It's not a blip.
It is not. And for you as an investor trying to build long-term wealth, you have to contextualize this. This isn't just a cyclical bump.
Right.
This is a secular trend. We are in a phase right now where the demand for AI and cloud computing is actually outstripping supply.
Wait, demand is outstripping supply. You mean they literally cannot build the servers fast enough?
That is exactly what is happening. Customers are lining up with cash in hand, wanting more AI capacity, more Azure instances, and Microsoft is just racing to build data centers to accommodate them.
Well, that sounds like a very good problem to have.
Eh,
But it does bring me to the topic of artificial intelligence.
the big buzzword.
It is.
Yeah.
We hear about AI nonstop. Every single company says they're an AI company now.
Right.
So is Microsoft actually making money from AI? Or is this just hype to pump the stock? Because I see a lot of press releases, but I really want to see the receipts here.
That is the trillion-dollar question. Show me the money. Well, with Microsoft, we're finally moving past the hype phase and squarely into the monetization phase. The evidence is right there in the productivity and business processes segment.
How much did that grow?
17%. But the real tell is the adoption of Microsoft 365 Copilot.
Copilot. That's the AI assistant built into Word, Excel, PowerPoint.
Right. It's essentially the paperclip from the 90s, but it actually works and has a PhD.
Poor Clippy. He was just ahead of his time.
He really was. But Copilot is a serious business tool.
Yeah.
And the adoption stats are wild. It has already been adopted by 70% of the Fortune 500 companies.
70%.
Yeah.
That is huge. 7 out of 10 of the largest, most powerful companies on Earth are paying Microsoft for this service.
Right now.
That is incredible market penetration. It feels like Copilot was just announced yesterday. Usually enterprise software takes years to roll out across a big corporation.
It moved incredibly fast.
Yeah.
And here's the figure that really matters for the skeptics. The AI business within Microsoft, just the AI layer, is positioning for a $10 billion annualized run rate soon.
$10 billion a year just from AI.
Just from AI. To put that in perspective, there are established companies in the S&P 500 that don't generate $10 billion in revenue total.
Right.
Microsoft has effectively built a Fortune 500 company inside itself in roughly 2 years.
Okay, that definitely answers the monetization question. But what about the competition?
Right.
You have Google, you have Amazon with AWS,
Yeah.
you have all these aggressive startups. Why is Microsoft winning this race?
It all comes down to the moat. In investing, a moat is that competitive advantage that protects your castle.
Sure.
Microsoft's moat is integration and switching costs.
Explain that for me.
Okay, imagine you are the CIO of a Fortune 500 company. Your corporate email is on Outlook, your documents are in SharePoint, your servers are hosted on Azure, your employees talk on Teams.
They're fully locked in.
Right. Now Microsoft comes along and says, hey, for an extra $30 a month per head, we can turn on an AI that reads all those emails, summarizes all those documents, and automates your Teams meetings. You click one button and it works.
Oh, wow. Versus hiring a startup, trying to integrate their software, making sure it passes security compliance, training your entire staff on a new tool.
Exactly. The friction to switch away from the Microsoft ecosystem is just incredibly high. You can't just rip out your entire corporate infrastructure because you want to try a different chatbot.
No, you really can't.
So by integrating OpenAI's tech across their entire stack, they've made it so the easiest path for business is also the Microsoft path.
They've trapped us,
Essentially.
but in a highly profitable way.
That is the nature of enterprise software. Stickiness.
Okay, so the revenue is great, the AI is real, but now we need to play the bear for a minute.
Let's do it.
I need to play the skeptic, because you mentioned earlier that investors were worried about spending.
Right.
I looked at the capital expenditure numbers, the CapEx,
Yeah.
and my eyes watered.
Yes, the CapEx controversy.
Controversy is putting it lightly. They are spending roughly $30 billion a quarter.
Okay.
$30 billion every 3 months. That is $120 billion a year. That is more than the GDP of entire nations.
It is massive.
They're spending that on what? Exactly. Concrete and microchips.
Mostly, yes. Data centers, energy infrastructure, and NVIDIA chips. It is an eye-watering amount of money.
Yeah.
And the bear case, the risk argument here is that this is reckless. People are asking, are they overbuilding? What if the demand dries up? This is a massive gamble.
It sounds like a gamble. If I spent $100 billion building factories and nobody bought my product, I'd go bankrupt tomorrow.
If you did it blindly, yes. But I would argue this is actually a bullish signal, not a bearish one.
Really?
You have to look at why they're spending it. Remember what we said about demand outstripping supply?
Or they have customers waiting in line.
Precisely.
Right.
You do not spend $30 billion a quarter unless you have signed contracts or incredibly high confidence signals that people are going to pay for that capacity.
That makes sense.
It's not inefficiency, it's necessary expansion. They are doubling their hyperscaler capacity to 98 gigawatts by 2027.
Hyperscaler. We hear that term thrown around a lot. For the listener who might not be an IT engineer, what actually is a hyperscaler?
Think of it like the utility grid, but for computing.
Okay.
A normal data center is like a generator in your backyard. A hyperscaler is a massive power plant that serves millions of people at once, scaling up and down instantly based on need.
And there are only a few of those.
Right. There are only a few companies on Earth with the capital and the expertise to build these. Amazon, Google, Microsoft.
So they are basically building the digital power plants for the next century.
That is a perfect analogy. They're laying the physical groundwork for the next decade of computing.
Yeah.
And once that capacity comes online, it just turns straight into revenue.
But here is my worry with that. If I spend all my money building power plants, my profit margins, the money I actually get to keep should plummet right.
You would think so.
Because construction is expensive. Depreciation is expensive.
That is the magic of Microsoft's scale. And frankly, it's what surprised Wall Street the most this quarter. Despite this massive spending, their gross margins held at roughly 69%.
Wow.
And their operating margins actually expanded to roughly 49%.
Wait, their operating margins went up
Yes.
while spending $30 billion on construction. How is that mathematically possible?
Cloud scaling. As the cloud business gets bigger, it gets exponentially more efficient. Plus, the software side of the business, Office Windows, has incredibly high margins.
Because it costs almost nothing to sell another copy of Word.
Exactly. That profit engine is so powerful, it is effectively subsidizing the construction of the future. They are defending their margins while building the infrastructure of tomorrow.
That is the ultimate definition of having your cake and eating it too. It really highlights the sheer financial health of the company. For the risk-averse listener who hears tech stock and immediately thinks volatility or risk, this seems like a totally different beast.
It is a financial fortress. Let's talk cash flow for a second. In fiscal year 2025, their free cash flow exceeded $90 billion.
$90 billion in free cash flow. Just so we are crystal clear on the definition here, that is, the cash left over after they pay all their operating expenses and after they pay for all that CapEx we just talked about.
Exactly. That is the money that lands in the bank account at the end of the year, free and clear.
And what do they do with a pile of cash that big? Do they just put it in a vault and swim in it like Scrooge McDuck?
They give it back to you, the shareholder.
Nice.
In the second quarter of 2026 alone, they returned $12.7 billion to shareholders through dividends and stock buybacks.
That is a huge safety net. Even if the stock price wobbles, you're getting paid a dividend, and they are buying back their own stock, which drives up the value of your shares.
right? It creates a floor under the stock price. This financial strength allows them to reinvest in AI without borrowing heavily.
Which is huge with interest rates where they are.
Exactly. If a smaller competitor, say an emerging AI startup, tried to spend $30 billion on data centers, they would go bankrupt or they'd have to dilute their shareholders to death. Microsoft just writes a check.
It puts them in a league of their own.
Yeah.
So we've established the fundamentals are rock solid. We know the AI story is real and monetizing,
Yes.
but the stock is still down 18%. What is the mood on the street? Are the big players scared?
The sentiment is actually shifting positively. Despite the price drop, the smart money is bullish. Goldman Sachs just named Microsoft a top growth pick for 2026.
Goldman doesn't usually throw that title around lightly.
No, they don't. And if we look at institutional flows where the big pension funds and mutual funds are putting their money, we see strong accumulation.
Who's buying?
Funds like Allspring are holding or adding to their positions. They aren't selling.
What about the insiders, the executives at Microsoft? Because if the CFO thought the company was in trouble, they'd be dumping stock, right?
Right. And we track that via Form 4 filings. We are seeing no significant insider selling clusters.
Okay.
There is no panic at the top. The people who know the company best are holding on.
So if I'm an investor looking at this today and I buy the argument that the stock is undervalued, what am I waiting for? What is going to make the stock go back up? What are the catalysts?
We have a few big ones coming up in the next 3 months. First is earnings. The Q3 fiscal year 2026 report is coming in late April.
And what are the whispers for that one?
Consensus is expecting around $88.6 billion in revenue.
Okay.
That would be another 14% growth year over year.
$88 billion. They're closing in on a $100 billion quarter.
It's mind-boggling.
It is.
And we're also expecting potential AI product reveals and further expansions of Copilot capabilities around that time. But there's also a major macro factor to watch.
The interest rates.
Exactly. As expectations for interest rate cuts solidify, we often see a sector rotation back into growth leaders like Microsoft.
Just explain that relationship for a second. Why do interest rates matter so much for Microsoft?
When interest rates are high, it's expensive to borrow money, and future profits are worth less today.
Right.
When rates come down, it becomes cheaper to finance growth, and investors are suddenly willing to pay more for future earnings. It effectively raises the ceiling for the stock price.
So the macro environment is starting to turn into a tailwind instead of a headwind.
Exactly. You have the price pushed down by temporary fear, but the earnings, the product pipeline, and the economy are all pushing up. Eventually, something has to give.
That leads us perfectly to the final verdict. We've looked at the good, the bad, and the incredibly expensive.
Yes, we have.
What is the final score?
Based on all the data we've analyzed today, the score here is a bullish 9 out of 10.
9 out of 10. That is extremely high confidence. Walk me through the elevator pitch.
Here is the thesis. You have the premier hyperscaler play with Azure growing at 37 to 39%.
Sure.
You have over 70% of their revenue coming from recurring sources. That's subscriptions, reliable income.
Right.
And you have over $90 billion in free cash flow funding compounding returns.
And the opportunity right now is just the price dislocation.
Precisely. The stock has fallen 18% year to date, but the fundamentals, the Q2 beat the Goldman endorsement, the cloud growth, all signal that it is significantly undervalued.
So what's the upside?
The thesis is a strong rebound. We could potentially see a 55% upside as the market realizes that this massive capacity expansion is actually going to pay off.
55% upside. That is a massive move for a trillion-dollar company. What is the timeline on a trade like that?
This is crucial. It is a multi-year hold.
Okay.
This isn't a day trade. Do not buy this thinking it's going to pop tomorrow.
Yeah.
This is a hold into fiscal year 2027 as that AI monetization really hits its stride and those new data centers actually come online.
So the play is to look past the scary red number on the screen today, that 18% drop, and focus entirely on the massive green numbers in the earnings report.
Exactly. You are essentially buying $1 for 80 cents right now.
I definitely like those odds.
It's a solid setup.
Before we wrap up, though, I want to leave you with a thought to mull over. We talked earlier about them doubling their capacity by 2027, going up to 98 gigawatts.
It's a huge expansion.
Right. But if the biggest cloud company in the world needs to double its size in just a year or two, are we actually underestimating how big the cloud is going to get?
That's a great question.
Because we tend to think of the internet as finished right, like we built it and it's done. But maybe with AI, we're just laying the first brick of something much, much bigger. Maybe the cloud isn't just for storage anymore. Maybe it's becoming the actual brain of the global economy.
It's a fascinating possibility. And if that's true, even a multi-trillion-dollar valuation might look cheap in hindsight.
Definitely something to think about. Thank you for listening.
Thanks for having me.
And remember, if you enjoyed this breakdown, make sure to subscribe so you don't miss the next one. We'll see you then.